We were under the impression that the stock market roared higher after reports of a trade deal going through. Nothing has been signed, nothing has been official. But the market wanted good news and it certainly got it. The real reason the stock market went higher, however, was that QE4 has been confirmed. The Fed is refusing to call it QE, but by anything other than its name, it's QE, so it really doesn't matter. True panic has set into the financial system and their acknowledgement is now official. You came here for the truth, so let me unveil that for you. I am sick and tired of being lied to, especially when it's done in this way. The central banks, in particular the Federal Reserve, have been committing crimes on a daily basis, devaluing the dollar of the people, and we need to start speaking up. Today I'm going to highlight what happened in the markets, okay? This has been a travesty to be lied to on a daily basis, but most people suck it up. Terrible, terrible, terrible what I see on a daily basis. Then we're going to look at what's going on with the Federal Reserve. We're going to talk about QE4. I'm going to show you what's happening with the repo markets. I'm going to give you the detail directly from the source itself. I want to show you what's going on as well with the balance sheet of the Fed, looking at several economic indicators such as the yield curve and others. It's going to be one hell of a video. Let's get into it right away. You can see what's going on in the US markets, the top three, S&P, NASDAQ, Dow Jones, all of which did very, very well. Today, the S&P happens to be going very close to that 3,000 mark. It's been awaiting this moment for a little while, trying to break through. If we do get some substantial news coming out, certainly it can persist. There's just one problem though. What we've been seeing with this trade deal has been non-stop, back and forth, constantly up and down. There's been nothing consistent at all over the last year plus. Take a look at this. David Dollar, a senior fellow at the Brookings Institute, told CNBC that the two sides are not discussing a trade treaty that requires congressional approval. It is more of an informal agreement in which China will undertake to do certain things, such as buy U.S. agricultural products, and the administration will undertake not to follow through with the next round of tariffs. Since those tariffs do not require congressional approval, the administration can postpone or cancel without that approval. So we are supposed to see some tariffs October 15th, and as a result, if this deal gets put through right now, those will be delayed. The interesting part about this is that there seems to be only two very small points. That China's going to buy U.S. agricultural products, which we knew already. That was one of the very first things that China said they would love to do. We would love to buy U.S. agriculture. This is great for the farmers, of course, great for a bunch of individuals there, but what does that do for the average consumer? We've already had multiple farm bailouts and there hasn't been much progress being made. This, of course, is good news. It is good that both sides are talking. However, it isn't even close to the trade deal that was talked about a year ago. They've simply abandoned that and they are trying to save face. Of course, as I said in the introduction, the market is looking for some good news and it found it. We have no agreement. We have nothing in writing. We have agreed to discuss the process on how to consult, during which we will discuss what to agree upon. Now get ready for phase 2 and meeting number 14. Northman Trader said it here, and I think it's important to highlight what he's talking about. He's trying to make a joke about it, but really it's kind of what's happening. Meetings about meetings. It sounds like a big corporation to me. That's the way the governments are always run, just to get two sides to sit down together takes so much time. There's so much planning, and most of the time it doesn't work out. And this is what has been going on now for such a long period, been wasting time in between this initial discussion, and now we have seen infighting. We have seen people that have claimed one thing or another, but I want to see actual documented facts. Unless we have that, as far as I'm concerned, it's meaningless. While markets are reacting positively to the likelihood of a limited US-China trade deal, it's critical to remember that all existing tariffs are expected to remain in place. And that is very key, because what you're seeing right now is the fact that these tariffs are still going to be there. The tariffs that are putting pressure on both sides are a problem that will not be resolved even if this limited trade deal goes through. Of course, one step at a time, I get that, but the problems we were having all along has nothing to do with this particular trade deal. Like I said, agriculture was something that China really wanted, and of course the US wants to give it to them. Ultimately, if we follow this chart here, we are always going to know what's going to happen in the market. The global liquidity proxy compared to the S&P, you can see this chart here time and time again. The money supply correlates entirely with the stock market. Of course, there are variances from time to time, but you can see this all throughout 2019, how accurate it really is. If they're willing to print more money, if they're willing to put money into circulation, they're going to give more loans out, etc., etc., you are going to see the stock market rise. Now, if we get a real sense of deflation that happens, all that needs to occur is the central banks kick in the printing presses, and you will watch the value of those dollars declining, and you can see certain asset prices driving higher and higher. The Federal Reserve, in fact all central bankers, are not to be believed. In any case, it's usually the exact opposite. This right here is Ben Bernanke. Subprime mortgage woes won't seriously hurt the economy. And he said this with a straight face. Now this happens to be back in May 2007. Everybody, I'm sure, is aware of what was happening around that time. We had the subprime crisis that was taking hold of what we were told was a limited part of the financial system, okay, at that time. This is his quote right at the bottom paragraph. We believe the effect of the troubles in the subprime sector on the broader housing market will be limited, and we do not expect significant spillovers from the subprime market to the rest of the economy or to the financial system. So not only will this have no impact on the housing market in general, it's not going to be a problem for the economy, not going to be a problem for the financial system. This was in 2007. The meltdown had already begun, and you had the central bankers consistently, time after time after time, telling everybody, don't worry, everything's okay. They were even saying this into 2008. That's how crazy it is, but people fell for it. Even today, there are still those people who have their Ben Bernanke magazine cover of The Atlantic that said hero, and they were talking about him as if he saved the day. No, when he lied to you back in 2007, 2006, and before that, none of that really mattered, right? Well, of course, all of these central bankers, no matter at what level they are constantly doing their own job, not to protect you, not to worry about your bank account or wallet. They really don't give a damn. The Fed is extending its overnight funding operations through January 2020. So, as I said so many times before, I've been covering this day to day. First we saw it was just going to be a couple days. Then, okay, October 10th, that's fine. Then November. Now January 2020. Is this ever going to stop? Is this just opening up the taps permanently? It could be, certainly could. You can see what happened here. This was supposed to be weaning off. They're supposed to be just fading away. Won't need these anymore. It was just a temporary issue. Oh no, it's not. Well, then it was just supposed to be because of that quarter end. It was gonna be just temporary. And then, oh no, it's not. But the market forgets about it very quickly, in fact. Here you can see what the Federal Reserve had to do in order to sustain this market, in order to keep it alive. Now, I found this interesting here. They're obviously making changes to their website. Normally, I show you the updates to give you an idea of what has happened with the Fed. They are actually doing site maintenance right now, and I'm wondering what they're going to add. Perhaps it has something to do with the new changes, with the introduction of QE4, but it's not called QE4. Maybe they're going to add that in there. I wonder what they're going to label it. It's going to be pretty funny. But of course, I will bring this to you in a future video to give you an update on it, because I think it's so important. And then we have the mainstream media. We have all of those out there who have so much invested, not only personally with their investments, but of course their jobs, their livelihoods, their family. Everything is relying on the financial system staying exactly the way it is. So in a way, I don't blame them, but sometimes the truth hurts and it's tough to swallow, and there really is no excuse to lie to people. Check this out. This is not QE or even QE light. The additional flow may still be welcomed by market participants. This is night and day with their previous QE attempt. Just modern day open market operations and nothing more. Can you believe this? The way that they talk to us, it's like we are scum. It's like we are garbage. Does anybody actually believe this? Please, if you believe it, put your comment down below. I could really use a laugh. This is the statement directly from the New York Fed's website. I always show you the data directly from the source, and you can see right here, out of their own mouth, in accordance with this directive, the desk plans to purchase Treasury bills at an initial pace of approximately $60 billion per month, starting with the period from mid-October to mid-November. These reserve management purchases of Treasury bills will be in addition, remember that, to the desk's ongoing purchases of Treasury securities related to the reinvestment of principal payments from the Federal Reserve's holdings of agency debt and agency mortgage-backed securities. When you total all this together, there is no telling how much they're going to be printing in a given month. I really believe that this is going to far exceed $100 billion a month, and I do believe that it will be larger than what we saw with QE3. Depends how long it goes for, but at least on a month-to-month basis, we're going to see extreme levels. They're not going to tell you that. They're not going to really highlight the concerns here, but that's what I'm here to do. Why don't you just read this for yourself, and you can place judgment on it as you feel necessary. Towards the bottom here, term repo operations will generally be conducted twice a week, initially in an offering amount of at least $35 billion per operation. Overnight repo operations will be conducted daily, initially in an offering amount of at least $75 billion per operation. So look at the torrent, this wave coming through the financial system right now. The liquidity is rushing in like crazy. We have the ECB ready to restart their own QE program. It's only 20 billion euro, but obviously that's going to have to increase. And the Federal Reserve is going into overdrive. They tried to scale back just a little bit, and you saw what happened. This is going to be insane. QE4 is going to be crazy. This right here is the balance sheet of the Federal Reserve. I actually had suspected that this would have gone a lot higher, but it seems to be in these two steps. If you can see how it's been working, you see 1 week it goes up at an accelerated rate, and then the pace slows down the week after, and then an accelerated rate, and then slows down. So we'll see if that is some sort of pattern that they've been doing. It is approximately 4 trillion, and of course this will go far, far beyond that. Right here, you can see this from Bank of America. They are just showing you the central bank balance sheet and where they expect it to go in the near future. It's actually going to go far beyond this because the Federal Reserve is going to print even more than what they thought, but we'll see as time goes on. Of course, you can see it here on the channel. I'll be tracking it. Looking specifically at the yield curve inversion, the 3-month 10-year spread has found its way out of the negative, and that is never a good thing. You know, look at it historically, okay? If you see this from time to time, we're looking at this chart back into the 90s up until the present day. It's not when you have the yield curve inversion that there is a problem. It's when it reverts. When it reverts, that's when we have a crisis. This is something that I've talked about all the time. It is extremely bad to see what we have right now. I mean, looking at this, it could simply reverse and head down even further. There's no telling, but in this way here, historically, this has been an extremely good indicator of a recession. So keep your eyes peeled. Jeffrey Gundlach said this: "We will probably start seeing the yield curve steepen, but that wouldn't necessarily be a good sign. That would almost seal the fate of recession coming. It's not so much the inversion. The inversion is a warning that there's one coming, but you start to get in the imminence category once it first starts steepening out of the inversion, because by then the Fed has realized it's behind the curve, the market knows it too, and everybody knows the Fed's going to be slashing interest rates." That's where we are today. Really quickly, just wanted to touch on this article out of the Financial Times. Central bank stimulus is distorting financial markets according to the biz. And it's funny because they're using that term distorting, something that I talk about all the time. You absolutely cannot intervene in the markets in the way that central banks have done and expect it not to be permanently ruined. This is never going to be fixed. It's like when you open up something, you unscrew everything, you tinker with the inside, and you try to put it back together, and it's never the same. Sure, it might work kind of, but it never operates the way that it was intended originally. That's just the way it is. Now, this article is actually really, really good. So if you can check it out, if you're interested on knowing all the details of it, link will be in the description as always. Then you have central banks, government, bond holdings. If you see this, it's extreme. Obviously, the Bank of Japan, over 40%, probably around 45% according to this chart. Bank of England has over 30%. The ECB, the Fed also own a substantial amount. Imagine this: when the central bank prints money out of thin air, they buy the debt of that particular country. We have seen this time and time again, and it has never, in 100% of the cases, never worked out well. That's all for this video. If you found it informative, hit that like button. You are supporting me when you do so. If you want to make money, if you want to build a business, if you want to learn about passive income, this is for you, okay? I created a step-by-step guide, a free e-course, 100% free, to teach you how to sell on Amazon. It's at theamazongps.com. If you want the financial education that was not taught to you in school, then you got to go and get the truth. These two books have everything in them, top to bottom, A to Z. Check it out at the link in the description. If you want the audiobook, that's available at themoneygps.com. Wait a second, don't go anywhere. I have such a detailed video for you, and I hope that you will spend a couple minutes, check it out, click on it, and I will see you there.